In today's video, I am going to be breaking down HCAL, which is a fantastic ETF. Actually, it's a very interesting ETF. This is the Hamilton Enhanced Canadian Bank ETF. Basically, I don't own this ETF myself. This is an ETF that somebody has requested me to review, and I thought I would do it because it's a very interesting ETF. It uses leverage to give you a higher dividend. So let's get down and let's check this out. Okay, so the ticker symbol is HCAL, and its current yield is 5.4%. They actually aim this ETF to be higher than 5%, according to the write-ups about it. The highlights right now is it's the top performing Canadian bank ETF, and over the last year it's had a massive 58% increase in total return. It also gives you exposure to Canada's big six banks. But this is the important, very interesting part, is that 25% cash leverage. Basically, they are using leverage to be able to purchase options and other financial futures of the big six banks to be able to leverage, of course, that to give you a higher return. Because right now, the average Canadian bank is giving you between 3.5% and 4% dividends. Meanwhile, this ETF gives you a 5.4% dividend. And if you are an investor who is looking for a higher yield and enhanced growth potential with a monthly income, which is the dividend distribution, then at that point, this could be a potential good option for you. But this leverage is going to really hurt you potentially in the future, and I will get to that later. So over the past month, it's down 1%. However, year to date, it's up 6%, and over the past year, it's up 46.6%. Since the inception, it's up 58%. In fact, the inception really wasn't all that long ago, so this could really skew the outcome as to why this may or may not fit your portfolio. This is also the growth of $10,000 invested, including dividends. So this also gives a false narrative as to where it's going, in my opinion. You would have to look at the NAV. This gives a true picture as to how good the ETF is performing over the past little while, of course, since inception. And we can see that it has increased as well. However, you'll notice that the increase here is not as big as what they say for the $10,000. And that is because when you look at the growth of $10,000 invested, this is if you reinvested the dividends. And generally speaking, not many people do that if you're looking for monthly income. Because most people who are looking for monthly income, for my example, myself, use that as a backup plan if business income isn't up to where it needs to be to pay for everyday expenses. So for example, when the pandemic was happening, I could back up on my dividend income while my business income dipped. Also for retirees and people who have either retired early or currently retiring, a monthly income is something that they would be pulling out themselves so that at that point they can live. Now basically this ETF holds HCA, which basically this is what it holds right now. They do update that about every quarter, and you'll notice that National Bank is up top, Bank of Nova Scotia is second, and then of course we start going down to CIBC, Bank of Montreal, and TD being the bottom three. And the reason for this is they actually will basically in that ETF itself, and technically this one too, they will do the least favored three banks as their biggest holdings. 80% of their in total holdings will be the three lowest banks, or at least favored banks during that quarter, and then the three most favored banks will be their smallest 20% holding. The idea here is very similar to what I've mentioned in previous videos, which is I generally don't buy the Canadian banks that are being favored at the time. I will always try to look for the banks that are not being favored. Now, I did just recently buy a lot of TD shares and CIBC shares, and they're clearly favored right now. However, generally speaking, I would be normally buying Bank of Nova Scotia, Royal Bank, or National Bank at this time. However, I personally believe that the growth is, I'll say, bigger potential right now, in my opinion, in CIBC and TD. I could be wrong, they could be wrong, we'll have to see in about 3 to 5 years. However, you cannot go wrong buying literally any of the Canadian banks. They generally will win no matter what. Management fee is 0.65%. That's that number right there. And why is that so important? Well, right now, what we are looking at is an ETF that is paying you a 5.4% dividend. Now, that is important to know because the average Canadian bank right now is generally around that 3.6 or 3.7 if you were to even them out. So if you were to even out the Canadian banks right now, you're sitting around a 3.7% dividend. Now, you may be saying, well, that's a much bigger dividend. I should go with this route. Well, you could, but we have to really also think about the management fee. Also, the growth potential or potential decline of this ETF versus holding the stocks individually. And what I'm talking about here is, of course, if we just look at the dividend alone and not look at the potential growth or loss on the underlying stock, you're looking at only a 0.7% or a 1.7% dividend difference. So if we were to basically negate that out, you are making 1% better overall. Technically speaking, if we take away the cost of the ETF and how much it will rise or not rise, the dividend itself is 1% higher if you put the management fee into that perspective. However, this is when leveraged ETFs kind of show what they do. And a leveraged ETF, if the stock market or that sector that you're leveraging is going down in value, you will actually lose more money than if you were to look at the positive side. So for example, let's make math very easy. And let's say you've got a leveraged ETF and it went up 1% when the entire market went up 0.8%. Well, now if the market goes down 0.8%, you actually go down 1%. Generally speaking, that's how it works. Not always, but if we were to make math easy, that is essentially how it would work out. So if the market went up 1% and your leveraged ETF went up 1.5%, that means that if you put in this, if you had the same amount of money in there at the time when the stock or the ETF or when the market went down 1%, you would also be down 1.5%. So if you were reinvesting those dividends, as an example, when that price of that stock was up higher and it was leveraged, that means that you would be actually losing more than what you essentially gained. So make sure to really know the ETFs before you get into it, and of course the time of which you're getting into it. Right now the Canadian banks are really hot, so you would think that this would be a good time to get into it, and it could be, but how long will they be hot for? That's the other question, because if you invest right now and the stock market starts going down, there's a lot of things that are happening around the world, this ETF could crash a lot harder than if you were to just invest your money in the basic banks. And if you type in on Google, what is a leveraged ETF, this is essentially what you would get. This explains it right there. So just make sure that you know exactly what you're getting before you buy an ETF. Personally, I would not be buying an ETF that holds just the big six banks. I could literally do that myself, and I currently do. I don't own any ETF that holds just the big six banks. I do hold ETFs that have the big six banks in it, but not just the big six banks. I can go out and do my own purchasing and make my own ETF essentially. However, obviously I can't over leverage those, but I can't leverage those. In a theory you could, but I personally can't myself. I'm not going to put in the time to be able to do that. However, at that point in time, is it worth the extra risk to do that? And that's the question that you have to kind of ask yourself is this risk there And should I take that extra risk? Am I okay with a 3.7% average dividend, or maybe go with something with CIBC, which is like a 4.1% dividend, get close to at least over that 4% range, and have that single stock risk versus that multi-stock risk? But at that point, you might as well, if you're going to just get an ETF and you're worried about risk, you could go with like something like a BMO Big Six Bank ETF, and you'll be set that way. But you would still be paying an MER, which will overall cost you what you might as well just go and buy the stock individually at that point anyways. I like to look at ETFs like HCAL and of course the different BMO Big Six Bank ETFs and things like that, just to see where they're sitting when it comes to their holdings. But I personally like to make my own decisions on the stocks that I hold if it's an ETF that's just going to hold 5 or 6 stocks. Anyways, that's my own personal thoughts. I wouldn't get this ETF myself, but if this ETF makes sense for you, go for it. Do it. But just know the risks always before you go and invest. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.